we'll discuss a trade entry setup from ICT called the Unicon model. This trading model occurs when a breaker block lines up with a fresh fair value gap area, creating a high-quality trading zone. So today, we'll explain what this strategy is and how to use it correctly on your charts. We will also check out some similar patterns that help create strong confluence areas like this one. So, what is the Unicon model? The Unicon model is a trading setup that combines a breaker block with an overlapping fair value gap. Before we dive into the details of this model, let me briefly explain these two concepts. A breaker block is a failed order block that transforms into a new supply or demand zone on the chart. From basic price action, we know that when the price breaks through a support level, it often becomes resistance because of how market participants react to that level. The same principle applies to order blocks. The market might ignore an order block for several reasons, such as a shift in market structure, the asset being overvalued or oversold, tapping into a higher time frame key level, and more. When a valid demand order block fails to reject the price and the price breaks through, it turns into a supply level. This is called a breaker block, and we expect the price to be rejected from this area. On the other hand, fair value gaps are also considered supply or demand zones. When a bearish FVG appears on the chart, it shows a sell-side imbalance where selling pressure has greatly outweighed buying pressure, often due to institutional activity. This creates a phase of market inefficiency, which usually causes the price to return to the FVG area to fill the gap and restore balance. This provides a trading opportunity to go short with bearish momentum, but only if there are still unfilled orders in the zone. That's when we see price rejection from these areas, followed by continuation movements. Keep in mind that fair value gaps must be unmitigated. FVGs are a one-time use. We only mark FVG areas that haven't been tested yet. If the price taps into an FVG zone for the first time, that's when we consider it a trading opportunity. After that, it becomes mitigated and is no longer valid for future trades. If you'd like to dive deeper into these concepts, check out our previous videos. Now let's return to the Unicon model. As we mentioned earlier, in this model, we look for a breaker block that overlaps with a fair value gap, creating a high-quality trading zone. When the price returns to this zone, there's a higher chance it will act as a strong supply area and push the price lower. In this case, we'll enter at the beginning of the zone, place our stop loss above it, and target the next key area ahead of the price. The same applies to bullish scenarios. For our first example, we'll look at the euro-dollar pair on the 5-minute chart. Focusing on the top of the recent impulsive movement, we have a fair value gap area. The candle responsible for this gap is considered an order block, marking a demand zone that could push the price higher. If the price retraces to this order block zone, we'd typically expect a rejection to the upside, signaling a bullish continuation. But what happens when the price breaks this zone without showing support? It turns the zone into a breaker block, flipping its role. The bearish move that broke below this demand area also created a fair value gap, signaling strong bearish momentum. Individually, the bearish FVG and the breaker block are valuable trading zones. However, when they overlap, they form a high confluence trading zone, making it a critical area to watch due to its increased significance. High confluence areas are zones where multiple price action signals align, making them more reliable. These areas attract significant attention from traders, as the convergence of signals often increases the likelihood of a strong market reaction. With so many participants monitoring these levels, they become key zones where traders anticipate and execute their strategies. Now, for the entry, you can set your sell limit order at the start of this high confluence zone. Place your stop loss above the zone to protect against market fluctuations. For profit targets, aim for a solid risk-to-reward ratio, such as 1:2 or 1:3, depending on key market structure levels ahead of the price.